Every spring, millions of Americans approach tax season with a mix of anxiety and resignation. Popular culture often frames loopholes as the exclusive domain of high-paid accountants working for the ultra-wealthy. The legislative landscape shifted recently. For the 2025 returns filed in 2026, the One Big Beautiful Bill has overhauled the rules of the game. Filing taxes using outdated habits now carries a specific cost, leaving thousands of legally protected dollars in the hands of the government. These new provisions serve as deliberate behavioral incentives written into the code, allowing ordinary citizens to secure significant financial wins through standard compliance. The first tier of the savings escalator involves passive deductions. These are automatic windfalls that require accurate reporting rather than complex financial maneuvers. The state and local tax deduction cap jumped from $10,000 to $40,000. Plus, taxpayers 65 and up can claim an extra $6,000 on top of their standard deduction, doubling to $12,000 for senior couples. Hourly and service workers also see targeted relief. The code now allows for a $12,500 deduction on overtime pay and a $25,000 break on reported tips. Consumers financing American-made vehicles can even deduct up to $10,000 of their loan interest, provided the car or pickup was assembled in the U.S. These passive perks lower your taxable income across the board, providing a windfall regardless of whether you itemize or take the standard deduction. The second tier of the escalator moves into active timing. These strategies require you to look ahead and manipulate your cash flow before the year ends. One powerful method is charitable bunching. This involves concentrating several years of donations into a single tax year to surge past the standard deduction threshold. Instead of donating annually for limited benefits, cluster gifts into a single $60,000 spike to double your savings. Using a donor-advised fund, you claim the full deduction immediately, then distribute the funds to charities over time. You can apply a similar timing logic to your investments through tax loss harvesting. By selling assets that have lost value, you generate capital losses that offset your gains. Those losses can even erase up to $3,000 of ordinary income, with any excess carrying over to future years. These active strategies turn fixed annual expenses and underperforming investments into controllable tax assets that work in your favor. Small business owners occupy the highest tier of the escalator, thanks to the structural flexibility inherent in running an enterprise. You can manage your tax bracket by shifting revenue across the new year boundary. Delaying late December invoices or shipments until January 1st moves that income into the following tax year. Hiring your minor children for legitimate work creates another advantage. It shifts business income to the child's lower tax bracket while exempting those wages from Social Security and Medicare taxes. Pass-through entities like S-Corps and LLCs should also secure the qualified business income deduction. This allows you to write off 20% of your business income right off the top. Finally, retirement accounts act as a dual wealth builder. Contributing $24,500 to a solo 401k builds your personal nest egg while immediately reducing your business's taxable profit. Savvy entrepreneurs use these timing and payroll maneuvers to legally engineer their profit margins and minimize their liability from multiple angles. The 2026 tax code provides a detailed map of the specific financial behaviors the government rewards. Capturing these rewards requires shifting your perspective. Tax planning works best as a year-round structural habit, rather than a frantic task for the spring. Because the rules are technical, you should use updated software calculators or consult a CPA to apply these expanded deductions to your unique situation. Mastering these rules creates a predictable strategy for long-term wealth building, allowing you to navigate the updated code with total confidence.